Hello friends, thank you for tuning in to our channel. In this video, we will be talking briefly about income statement. Welcome to our channel, and for all those first-timers, this is little as 5 minutes, your one-stop destination to learn a new lesson in just less than 5 minutes. The purpose of an income statement is to report the revenues earned by the company's efforts during a given period and report the expenses incurred by the company during the same period. Under the accrual basis of accounting, revenues are recorded when they are earned, not when the company receives the money. Recording revenues when they are earned is the result of one of the basic accounting principles known as the revenue recognition principle. The recording of expenses with the related revenues is associated with another basic accounting principle known as the matching principle. The format of the income statement will vary according to the complexity of the business activities. However, most companies will have elements of revenues and gain, and expenses and losses in their income statements. Revenues from primary activities, revenues or income from secondary activities, and gains, e.g., gain on the sale of long-term assets, gain on lawsuits, are a few of the elements to be booked under revenue and gains. However, expenses involved in primary activities, expenses from secondary activities, and losses, e.g., loss on the sale of long-term assets, loss on lawsuits, are to be booked under expenses and losses. If the net amount of revenues and gains minus expenses and losses is positive, the difference is reported as net income, else, if the net amount is negative, it is reported as a net loss. Let's understand the components of the income statement in little detail. 1. Sales. Fees earned from selling products and/or providing services. Under the accrual basis of accounting, sales are recorded at the time of delivering the service or the merchandise, even if cash is not received at the time of delivery. Often the terms income and revenues are used instead of sales. 2. Cost of goods sold. It includes all the direct costs associated with the production of the goods sold during an accounting period. This amount includes the purchase price plus SIF paid on raw materials used in manufacturing the goods and the labor cost incurred in production and other indirect expenses incurred in the factory, e.g. power, factory rent, depreciation on a factory machine, etc. It excludes all other expenses including general, selling, and distribution costs. The formula for computing COGS is COGS equals materials used in production plus direct labor cost plus direct expenses. 3. Gross profit. Gross profit or sales profit is the difference between revenue and the cost of making a product or providing a service, before deducting overhead, payroll, taxation, and interest payments. The calculations can be arrived as gross profit equals sales, cost of goods sold. 4. Selling and administrative expenses. It includes office rent, depreciation on office furniture and equipment, the salary of office staff, advertisement charges, packing and delivery charges, etc. 5. Earnings before interest and taxes, EBIT. EBIT is the difference between gross profit and selling and administrative expenses. It is a measure of a company's earning power from ongoing operations, equal to earnings before deduction of interest payments and income taxes. It is also called operating profit or operating income. The calculations can be arrived as EBIT equals gross profit, selling and administrative expenses. 6. Interest and taxable income. Interest is the fee charged by the lender on loans borrowed by the company. And taxable income is the amount of income subject to income tax or the income on which the company is liable to pay income tax to the government. 7. Taxes. Annual tax levied by the federal government, most states, and some local governments, on an individual's or corporation's net profit. It is calculated by multiplying the taxable income with the appropriate tax rate. 8. Net income. Net income is equal to the income that a firm has after subtracting costs and expenses, e.g., depreciation, interest, taxes, and other expenses, from the total revenue. Net income can be distributed among holders of common stock as a dividend or held by the firm as retained earnings. 9. Dividends. A dividend is a share of a company's profits that it pays to investors. When a corporation earns a profit or surplus, that money can be put to two uses. It can either be reinvested in the business, called retained earnings, or it can be paid to the shareholders as a dividend. A dividend is allocated as a fixed amount per share. E.g., if a company has declared a dividend of $5 per unit and the shareholder has 1,000 shares of the company, he will receive 1,000 shares $5 equals $5,000 as a dividend. 10. Retained earnings. Retained earnings, also known as retained surplus, are the portion of a company's profits that it keeps to reinvest in the business or pay off debt, rather than paying them out as dividends to its investors, shareholders. Retained earnings are reported in the shareholders' equity section of the balance sheet. Let us know how you find this lesson. Was there anything you already knew? Did you find this useful? Do you have any related information you would like to share? Leave it in the comments below, we love hearing from you. And if you liked our video, don't forget to give it a thumbs up and share it with your friends, this I bet to them as well. Hit subscribe and ring the bell right now to stay updated on more such little interesting lessons that will matter the most. Stay tuned.